That brings me to, I saw a really interesting stat by Ryan Dietrich. He's a market technician and reemphasized, and there's a lot of ways to cut this data, but, and I don't like general stats like this, but this one really stood out to me. The market since 1990 has averaged just shy of 10% per year, the S&P 500. And if you took out the 10 best trading days per year, just the 10 best trading days in arguably like 252 day trading period, the market was negative almost 13% per year.
It's amazing.
And so what that means is the really big days in the stock market are really important to be a participant in. Now, when do those big days occur? Those big days don't occur when markets are at all-time highs. The market isn't at an all-time high and then you see some 8% jump higher in stocks, collectively speaking. Where you see a big jump in stocks is after a pullback and the ensuing rebound from those positions. So this is part of the game. What investors have to realize is that this is normal. Even though it's uncomfortable, you have to lower your shoulder, grit your teeth, and get through it because it's a normal part of being an investor.
Yeah, and two things kind of come to mind with that. Number one, we talked about the VIX and volatility being high. Well, it's not just downside volatility. That includes upside volatility. So when the VIX is high, to your point, you have the circumstances are right for larger up days as well. So that's I think that's like a major point that we can't take for granted either. The markets are going to do their thing. I think also for people, for individual investors who are feeling right now like, oh man, the markets have been down, they've been down. This is normal. But also, when in doubt, zoom out a bit. And over the 1 year, over the 3 year, generally speaking, you should be very positive from the market performance, since 22.
We're not that far off all-time highs, not just revisiting a prior high, all-time highs in stocks. And so these are great periods of time to remind investors that stocks don't just move in one direction, straight up. They go up and every now and then they go down. The history of the stock market would suggest that every 7 years you have 6 advances for every decline. And so it's the dance of the stock market. 6 steps forward, 1 step back. 6 steps forward, 1 step back. So that is totally normal. Now, I want to clarify because we, just like the media, just like our clients, like most investors, generalize the stock market as the market, and we're typically talking about a composite index like the S&P 500, which is market cap weighted. It favors or it gives the largest companies more influence on performance. So if Apple is a huge company and does really well, it'll pull the index up. If Apple is a huge company and it's doing really poorly, it'll pull the index down. Well, when we look at the stock market on an equal weighted basis, meaning the same 500 companies in the S&P 500 composite, but give each company an equal shake. So an Apple might have the same influence as a Johnson Controls. When you look at the stock market on an equal weighted basis, things aren't that bad. Really, where you're seeing a big part of this sell-off is in the Mag 7. It's in the companies that over the last couple of years have been virtually untouchable.
Yeah, and that leads to concentration risk. But when everybody is buying the same stocks, you run out of buyers, and then you can have some downside, some downside with that too. There's companies like Abbott that are up almost 20% year to date. There are companies that are up. I know CVS is a big gainer. There's a bunch of companies I could go through that are actually wildly positive, but they're the more value-oriented stocks. They're less the ones that have done really, really well over the past 3 years.
Yeah, and then a great way of looking at that is if you took a composite of all the discretionary companies, consumer discretionary, the consumer has the choice of whether they want to buy this item or not. It's not a staple. It's not something that they absolutely need. That's a requirement. And when you look at that relationship of the discretionary companies relative to the staples are outperforming dramatically. And that's something that is typically a risk-off move, which makes sense. But we're seeing it in the market data. The question is how long does this last? And have these bumps and bruises to the stock market, they're going to cause serious concern? And I still hang my hat on the answer is no. I think we're one or two headlines away from being back to all-time highs based on change in rhetoric from the Oval Office. So this environment can change so quickly. It can change so quickly. The idea that the world's gonna end, and this is the reason the history books are gonna write about the downfall of the U.S. because the tariffs were put in place. Just it's not gonna happen that way.